All righty, everyone. Welcome. Good to see a lot of family or from familiar faces, I should say. Thanks for coming today. We'll be talking about creating your game plan for 2024. So lots to get into. I have lots of content, lots of slides, and yeah, I'm looking forward to feeling like we can actually prepare. I feel like in my own business and with a lot of our customers, it's been very difficult to plan and create a plan when nobody really knows what the heck is going on. And for the first time in quite some time, it feels like we have a little bit more certainty, not a lot, but a little bit more certainty that at least rates won't be continuing to go up. And so a little bit closer to that timeline that we'll see rates starting to come down. And what does that usually do for real estate and real estate prices? It makes it more affordable. Usually rates go down, prices usually end up going up. And so we've had a lot of investor clients reaching out to start to get prepared and start to look at preparing themselves to potentially buy something in 2024. So just so everyone knows, this webinar is for three different individuals and three different types of people. It is for first-time home buyers. It is for those that have pre-sale contracts that need to make sure that they're getting set up, and it is for investors preparing to buy. I'll apologize in advance. Sometimes there'll be some things then we'll be talking about that will be related to mostly investors, and some things that we'll be talking about that will be related mostly to first-time buyers buying their first home. But I do want to make sure that we go through a couple of these items as first-time home buyers are also preparing themselves to buy in 2024. So I do want to make sure that we hit the important notes and items on that too. Really important when we're looking at preparing and setting up a game plan is that if you fail to plan, you plan to fail. So what I wanted to be able to do is go through this today and be able to paint a picture for some of the things you need to be thinking about, some of the things that you want to be starting to plan, and creating a bit more structure to be able to take the next step, whatever your next step is. And one of the important points, of course, is just trying to get organized, making sure that you're organized, you have a plan, you know what your intention is for the year, and then you can get going. Now, really important. We sent over an email very recently, probably about 30 minutes ago or so, to all of the attendees, and that was with a what's called a portfolio game plan worksheet. So those of you, especially those of you that are looking at buying multiple properties or already own multiple properties, please make sure that you get that. If you do not have it, then you can also download that as well. So I'll just post it in the chat here. That link should take you to the worksheet. And if it doesn't, please let me know, and I'll be happy to make sure that everybody can get a copy of that. Okay. And as I go through this, I will be trying to break it down into chunks and going through sections of looking at what is the typical first step when you're trying to create a game plan for yourself on setting yourself up for success in 2024. So the first thing that anybody really needs to look at is if you want to buy something in 2024, you need to figure out where your down payment is coming from. And there's a number of different sources that you could come up with. And this would be the first section in the portfolio game plan worksheet, which would be looking at how much cash you have available in liquid investments in your bank accounts. Also, if you own property, then what is the value of that residence and what's the outstanding mortgage and line of credit? And then you can look at how much available equity you may have if you were to refinance that property up to 80% financing. We'll talk a little bit more about the refinancing in a little bit. And then, of course, other sources like a gift or inheritance or whatever it is that you might be coming up with in additional funding. And that's going to give you your total available to invest in real estate. So let's dive into these a little bit more specifically. If we're looking at own resources, this could be classified as your cash savings, your RSPs. For those of you that might be setting up the FHSA, first-time home buyer savings account, and of course a gift, although it's not technically own resources. If you're receiving a gift, then I'd probably put this into this particular bucket. Many of you, if you already own a property, then we usually recommend that you look at using a HELOC for your down payment. So if you already have that set up, then great. You've already achieved step number one, which is figuring out where your down payment is going to come from. I will be talking a little bit more about how to properly use a HELOC if you're hoping to use that for purchasing a property in 2024, and a couple of slides about the proper setup of this and the tax deductibility and whatnot as well. And then the last item here too is refinancing. So if you do own real estate, and you're able to qualify to borrow up to 80% of the value of that property, then that's another option. So if you have a home that's worth $1 million and you only owe $300,000 on it, in theory, you could refinance and get access to $800,000 in total. And $800,000 minus the current $300,000 that you owe, that's $500,000 of new money that you could be using towards your down payment on a new purchase. And keep in mind, you don't need to, when you're refinancing, you don't need to take all that money out. You could be just refinancing to get access to money. And that's, again, using that HELOC or home equity line of credit type of product. So when we look at things, to make sure that you understand, too, how much money you need in order to buy a property, you need your minimum 5% down for your own residence or for a second home. And this is a very common misconception that you don't need 20% down if you are not a first-time home buyer. So as long as you are purchasing your own primary residence and the purchase price is under $1 million, you can buy with as little as 5% down. Now, technically, it's 5% of the first 500 grand and then 10% of the remainder. So if you bought $1 million home, then it would be $75,000 in total down payment. So more like 7.5% down. But it's important to note that if you're buying your own residence or second home, you can go with as little as 5% down. You do not need to be a first-time home buyer. So if you bought a number of years ago and sold and you're buying again, you can do it with the 5% down. If you bought and already own a home and you still want to keep it and keep it as a rental, you can buy a new residence with 5% down. And in fact, that's a bit of a strategy, because when you buy a rental property on its own, the down payment is 20% down. So some of our clients, their game plan is that they want to build a real estate portfolio, but they don't have a lot of liquid cash. One of the ways to do that is to buy something that would be a good residence for yourself today with 5% down. And then eventually, when you're ready and you have enough funds saved up and you can qualify, you then keep that as a rental, and then you buy a new property that would be your residence, and you do that again with just 5% down. So just something to keep in mind as far as creating a bit of a game plan or strategy. Even if you're buying your first home, you still want to think about, well, how much down payment should I do? Maybe you have 10% saved up. Maybe if your plan is to buy another property in a year or two, maybe instead of buying a property now with 10% down and then waiting and saving up 20% down for a rental, maybe you buy a place right now that is a good residence for you now, but would be a good rental in the future. You buy that with 5% down, and then you can work on saving up your 5 or 10% down for your next purchase. That would be your residence, and you just keep the existing one you bought as a rental. RRSPs, keep in mind that each applicant can take out up to $35,000 out of their RRSPs. And technically, the FHSA account does allow you to take out up to $40,000 each, although you wouldn't have been able to contribute that much money into this account just yet. And we'll talk a little bit more specifically about that account because it's brand new, and they have an amount that you're able to contribute into it each year. And the last one I want to talk about too is borrowed down payment. And so we talk, about what your cash down payment requirements are, which is residence 5% down, rental 20% down. And you can borrow the down payment, believe it or not. Even if you're putting just 5% down and buying your own residence, there are actually programs you can borrow your down payment. I don't necessarily recommend these programs just because, number one, it's very hard to qualify for. They use a very high payment associated with borrowing the down payment. Your CMHC insurance premiums are just a little bit higher when you do this. And so most people, especially with home prices being so high in major urban centers, it's very difficult in general to qualify. And so we're only finding that in rare circumstances, in cases where the borrower has a very high income but just doesn't have a lot of savings, where the borrowed down payment type of program could work. And believe it or not, you could even borrow your down payment off a credit card underneath that program. Again, don't really recommend that, but it is available to you in case you wanted to look at more creative options for coming up with your 5% down buying your own home. Now, on the flip side, borrowing down payment for buying a rental property, very common. Typically, people are using a home equity line of credit for that. When you're buying a rental property, most lenders will not allow you to borrow money from an unsecured source. And so an unsecured line of credit or a credit card is not typically a valid source of down payment for a rental property. So just something to keep in mind. And in addition to that, even a gift, most lenders don't allow gifted down payments on rental properties either. So if you're wanting to get a gift this year and then buy a rental property, a lot of lenders don't allow that. There are some that allow it, but not every lender will allow a gifted down for a rental. So let's compare the FHSA versus an RSP. So if you're a first-time buyer, and by the way, underneath both of these programs, even if you have owned in the past, if you have, or you and the person buying it with you have not been on title of a home for 4 or more years, then you do requalify as a first-time home buyer underneath both of these programs. And so both of them, that the objective or the reason to use them is that whenever you put money into the program, it reduces your taxable income. So if I put $10,000 into an RSP or an FHSA, if my taxable income is 100,000, now it will reduce it down to 90, and then I only pay a tax on the 90. Now, the reason that people get a tax refund when they use an RSP or an FHSA is because they've already paid their taxes during the year as if they're making 100,000. But now if their taxable income is less, then they don't owe the government that much money. The government actually owes you money. And so this is where these programs can be interesting, because you're putting money into an account that you get to use for your down payment soon, and you get a tax refund. So it helps you prepare to purchase your first home. Underneath these programs, there are some limits. So an RSP is a little bit different because the RSP contribution limit is based off of your income. And so I don't have details in here because it's more complicated. But the FHSA is fairly straightforward. It's $8,000 per year. And the way that this works is you can put up to $40,000 into the FHSA over the lifetime. The RSP program, you can pull out up to $35,000 per person underneath the first-time home buyer program. And so slightly different amounts. The FHSA, because you can only put $8,000 per year and it hasn't been around for a long time, people won't have enough money in there to pull out the same amount of capital as they would if you had the money in an RSP. Next step is the tax-free withdrawal, very important. So the FHSA is tax-free withdrawal as long as you're using it towards the purchase of your home. And there are some stipulations on when you can pull the money out, et cetera. And I won't go into a lot of details there because there's some really good resources online from the government and other sources there to go into those details. But high level, you can pull the money out tax-free. And the same underneath the RSP first-time homebuyer program, you can pull the money back out tax-free. The key about the RSP program is that you must repay these RSPs that you pull out underneath the first-time program within 15 years. So if you pull out $30,000, you'd have to repay $2,000 per year to recontribute $30,000 back into the RSPs underneath the program. Whereas if the FHSA, you don't need to recontribute into it. In fact, if you contribute into it and then you realize that you don't want to or decide not to buy a home, for instance, or don't qualify, you can actually transfer the money out into an RSP or even a RIF, which is something that you would do only at the age of 71 years old. But at the end of the day, there are some options here to start to save up your money. And one of the things that I really wanted to highlight is, which is something that's quite cool, is the ability to create some money out of thin air. Because if I have $30,000 in a cash or a TFSA, and I put it into an RSP or a first-time savings account, which, by the way, you wouldn't be able to contribute $30,000 right away because the contribution limit wouldn't be available. That's why I use the term RSP here. But in theory, if you put the $30,000 in, and let's say that your tax bracket is 30% tax, then you would put the $30,000 into the RSPs. You would save about 30% of the $30,000 and get $9,000 back on your tax return. And what ended up happening is now you have the $30,000 in the RSPs and you have $9,000 tax refund from the government. So you've actually turned $30,000 into $39,000, which is really cool. And so something to keep in mind is if you don't have money in RSPs or the first-time homebuyer savings account, you can take cash that's not in those accounts. You can put it into those accounts and then withdraw it when you're ready to buy your home. There are some limitations on when you can borrow the money and take it back out of these two accounts. You have to be wary of when you're putting the money in and then when you can take it out. For example, money has to sit in an RSP for 90 days before you can withdraw it. So if you had an offer on a home right now, you couldn't put the money in and then withdraw it in 30 days because it needs to be in there for 90 days before you can take it back out. Daria has a quick question. If the person owns a rental property and is planning to buy a principal residence, can he or she use the FHSA and or the RSP, or is the benefit gone? So if you're on title of a property, then typically they're gone. I'd have to double check and see if there's any exemptions if the property has never been a residence of yours. My understanding is I think the rule is that if you're on title of a property, then you don't qualify. However, there might be a rule of, that allows you not to do it. I know for property transfer tax, If you're a first-time home buyer, if you buy under $500,000 in British Columbia, then you don't pay property transfer tax as long as you're purchasing your own home. I know that underneath that program, if you owned a rental and you have not claimed the first-time home buyer eligibility on the exemption for property transfer tax, then you could still do that. So if you bought your first property as a rental, you're going to pay property transfer tax on that. And then if you buy your residence and it's under $500,000, then you would not have to pay the property transfer tax. But I don't know about, I believe RSPs is just looking at whether you're on title of a property or not. So that would be a little bit of a different situation, but I'd have to check the fine print on that. I wouldn't say 100% for sure. So the other option too, of course, is not just using your savings, it's also using your home equity. So if you already own a home and you're looking at getting set up and getting prepared to purchase more property this year, then you can use your own home to do that. And there's a lot of different ways of doing this, but the way that I like to explain is to look at a home equity line of credit style product. This is one of the things that's often step number one. If you're looking at keeping your existing home and buying other properties, this is usually one of the most important things to do. So if you don't already have this, then you do want to look at getting this set up. Basically, it's a readvanceable mortgage. And the idea behind it is that as you pay down your mortgage, your line of credit limit will slowly increase. And so if you had a home worth $500,000, then in this case, and let's say that you have a $225,000 mortgage, you could have your $225,000 mortgage, and then you could have $175,000 available to you as a line of credit. And the reason that you can do this is because you can get up to 80% of the value of the property accessible to you. Now, there are some rules and guidelines that have recently changed that make it harder to re-advance all the way up to 80% financing. And so if you're all the way up to 80%, then as you pay down the mortgage, some of the line of credit limit will not automatically increase for you. However, especially those of you that have a lot of equity in your homes, if you're under 65% financing, then dollar for dollar, as you pay down the mortgage, the line of credit limit will increase. And the reason that this is a really attractive option is that your personal mortgage for your own home is not tax deductible. But when you borrow money to invest, the interest portion of the payments is tax deductible. And so if I borrow money out of my home and then use that for down payment on a investment property of some sort, and I re-borrow that money back out, then that money is tax deductible, and then I get to claim an interest deduction. So I reduce my taxable income when I use this type of product or method. And then I have cash, and I don't have to make the decision of either use my cash to invest or use my cash to pay down my mortgage, because in theory, I can use my cash to pay down my mortgage, which in turn increases my line of credit limit, and then I can use that line of credit to then borrow against and in order to invest. And so that's something that that is a very common product. If you have your mortgage coming up for renewal this year and you're wanting to get set up, this is, if you don't already have one of these, this is something that's really important. And so I do highly recommend that you look into a product like this and understand how a home equity line of credit product works. Next up is just talking about the good debt versus bad debt, and we've already talked a little bit about how a HELOC works. But in general, what you're trying to do is you're trying to eliminate your bad debt. So that would be depreciating assets and any consumer goods. One of the things that's really important here, and we will talk a little bit about this when we get to the income section of creating your game plan, but if you have consumer debts, if you have car loans, if you have other things like that, it will drastically impact your ability to qualify for a mortgage. And so it's really important that you look at trying to eliminate all the bad debt. Basically, borrowing money to purchase something that's going to go down in value is considered bad debt. A consumer good, something that you consume immediately, is not considered good debt, is considered bad debt. You know, spending money to buy IKEA furniture and keeping that on a credit card is not good debt, that's bad debt. So basically borrowing money to buy depreciating assets is bad debt. Good debt would be considered by borrowing money to purchase appreciating assets, because at least if you're paying interest, at least you're expecting that the value of the asset will increase. And so if you're doing that and you're purchasing real estate or stocks, et cetera, that's considered good debt. And of course, tax deductible debt is the target here, or the objective. So not just having good debt, but having tax deductible debt. So if you set things up properly, we always recommend that you talk to an accountant, make sure you set up things in the best way. And we're fairly familiar with what an accountant will likely tell you, but we always recommend talk to an accountant, make sure you get proper advice on this, just to be able to confirm, are you is it tax deductible, or is it not tax deductible? All right. There's a quick question here that I'll answer. Is a HELOC typically variable rates? Is there benefit to wait until the rates go down before setting up a HELOC? A HELOC is a variable, so you can choose inside of the interior of the product. You can choose to have a locked-in mortgage, which can be fixed or variable, and then the line of credit component is always variable. It's always moving with prime, and usually most banks are prime plus 0.5. Some banks will offer slightly better interest rates than that on a line of credit, but typically it's about prime plus 0.5. Now, one of the things that's important is lenders do often allow you to have multiple segments inside of it. So you can borrow money against a line of credit, use it for down payment, and then you can lock that in. So you can have your own personal mortgage portion, and then you can have another locked in portion, which is your portion that you borrowed for an investment. And then that way you're able to convert that and lock that into a fixed rate or a variable rate and compare that. Also, I noticed there's a couple of questions about interest rates. Don't worry, I'm going to talk about interest rates, but that is near the end of the presentation. So I'll be able to go through and answer a lot of questions about, the expectation of where interest rates are heading, et cetera, and what to do. But long story short, to answer that question, you can get a HELOC, and if you're not using it yet because you don't have an investment, then you can just ride it out. And in some cases, if we think and expect interest rates to drop, which, by the way, hint, hint, is the prediction for 2024, then you could just let it sit on the line of credit, wait until rates drop a little bit, and then maybe lock it into a fixed term or a variable term in the future. So we've went over the down payment sources. So there will be the cash, looking at being able to refinance and get access to your residence, either with refinancing or through a HELOC product. And then, of course, other sources like a gift. And so you'd be filling in this sheet and putting in all of your down payment sources and trying to total how much money you have available to invest in real estate. So I do want to talk about the next section now, which is the income section on the portfolio game plan sheet. And so you'd want to be looking at, are you an employee or self-employed? And if you're a self-employed, then are you incorporated or a sole proprietor? That does make a difference as far as what your income can qualify you for. And there are different programs available depending on whether you're incorporated or a sole proprietor. Now, if you're an employee, this is really, really easy. The lenders are always looking at either your minimum guaranteed salary or what you've averaged for the last 2 years. And so if you're an employee, you might have a base salary and you've gotten some raises over the last couple of years. And if you've gotten a lot of raises and most of your income is based on your base salary, then you're probably just using your base salary here. If you have a salary plus a bonus component, then you're often using the 2-year average. So whatever your last 2 years of T4s is. Now, we just started 2024, and so you might not have your T4 for 2023 yet, but you can grab that number from your year-end pay stub and just see what the total gross income is with all of your sources of taxable income. And you can use a 2-year average for that number plus your last years of T4. Now, if your salary is higher than that number, then you want to use the salary. If the 2-year average is higher, then you can use the 2-year average. So you can use, in this case, whatever is higher. If you're self-employed, then you're using the same thing because you don't have a guarantee if you're self-employed. They're going to be looking at what your 2-year average is. And that's the 2-year average that you claim on your personal tax returns. And so they're always going to be looking at, okay, well, what are you paying yourself? If you're a sole proprietor, when you file your taxes and you set all this up, you'd have your total gross income, and then you have your expenses, and then you have your net income. Whatever that net income is that you claim on your tax return, that's the number that lenders are going to use. And if you're incorporated, then it's what the amount is that you pay yourself. So either T4, so salary that you pay yourself, or the dividends that you pay yourself. And then again, that's the 2-year average. And then we'll get into some more creative products as well, because for self-employed borrowers, this is often difficult to qualify based on your income. Now, the math is, and I had to go through this form and change it, by the way, but because interest rates have increased quite a bit over the last couple of years, it used to be that you would qualify for $100,000 for every $20,000 of income. Now it's $100,000 for every $25,000 of income. So in this example, if you have $125,000 of income, then you qualify for about a $500,000 mortgage. This assumes you have no other debts, by the way. So if you have a car loan and you have a student loan and you have some credit card debt, then that's going to decrease the total income amount, or the total amount that you qualify for based on your income. Also, when we get to this later, if you own real estate and have a real estate portfolio, this number is likely to be negatively impacted. Usually properties in a portfolio also have a negative impact on your overall borrowing power. So these are things that you need to take a look at and make sure that you have a good, clear understanding of. But the general rule of thumb, especially for something that's simple, you're buying your own home, it's usually $25,000 of income equals $100,000 in a mortgage. The other way to look at it is multiply your income by 4, and that gives you a rough idea. As interest rates drop, this number is going to change a little bit, because as the interest rates drop, the qualifying rate will also drop, and it'll make it a little bit easier for you to qualify for a little bit more on a mortgage too. So if you're finding that you're really tapped out, then just consider that. Now, I'm going to go back on this unsecured debts and give you a quick idea of how unsecured debts can hurt you. If you owe $20,000 on a line of credit or a credit card or anything like that, lenders use 3% of the outstanding balance for the payment. So if you owe $20,000, they'll use a $600 a month payment. Now that $600 a month payment is about the same as borrowing $100,000 in a mortgage, because that's the current payment per 100 grand approximately. So just by having a $20,000 unsecured line of credit or credit card, that would be the equivalent of you borrowing $100,000 in a mortgage. And so it's really important to get that unsecured debts paid down as much as possible, because it will have a negative impact on your mortgage. Just opening up a quick question. My parents are renewing their mortgage every 5 years. They did not set up a HELOC at the start. They're both retired now. If they wanted to set up a HELOC, do they need to pre-qualify for the mortgage and or HELOC? So yes, you do need to qualify for the HELOC when you get it. Going through a HELOC process is actually basically the same process as getting a mortgage. In fact, it's slightly more difficult to qualify. Susanna, nice to see you. I'll send you the information afterwards. So if you're self-employed, the income is based on the 2-year average. Now this means that if 2023 was a bad year, you should be buying as soon as possible. And the reason I'm saying that is that taxes aren't due to be filed yet until the spring. And so right now, lenders are still using 2021 and 2022 tax returns to determine your income. So if 2023 was a bad year, then buy as soon as possible. If 2023 was a good year, then you should file your 2023 taxes as soon as possible, because that's going to increase your borrowing power. Now, it's really important to understand, especially if you're self-employed, there's this teeter-totter here, that the lower, the higher that the taxable income, the higher the qualifications, and that you're always trying to balance this out to ensure that you don't pay too much in tax and you can still qualify for the mortgage. So just keep that in mind, that this is something you always have to watch out for. The accountant always wants your taxable income to be as low as possible, but then that lowers your qualifications, right? But at the end of the day, the accountant's trying to do their job, and that's trying to lower your taxable income. So it makes it harder to qualify in many cases. Many self-employed borrowers don't show enough income on paper, but there are some creative solutions to that. The first one I'll talk about is called corporate net income. And so what the lenders use is they use the corporate income that was earned and stays inside of the company. So if your company earned an income and it stayed inside of the company, then we can use a percentage of that income as if it was take-home income. These programs always need 20% down. The lenders usually use about 50% of this corporate net income, and you must own the company 100%. And they typically will allow you to do either owner-occupied, or some lenders even allow you to do rental properties underneath this program. There's also stated income, where you state the income necessary to qualify for the mortgage, and then you prepare a case that shows that it's reasonable. So these are difficult to qualify under, but if it basically allows you to reverse engineer the maximum amount that you can qualify for. So instead of usually saying, here's my income, what do I qualify for? You reverse it and say, well, this is what I want to qualify for. How much income do I need in order to qualify for that? And then we determine if that's reasonable or not. And we basically go through, and myself and my team, we go through all of the details, collect as much data as possible, and then prepare a really good story to send over to the bank to say, we think that this is a reasonable income allowed for the borrower, and here's why. And we usually have to provide some good documentation and a good explanation on that. Usually we can't state your income a lot higher than what you've actually been earning, by the way. So that's something to keep in mind. These programs require 10% down minimum, and it's only for usually only for owner occupied and insured mortgages. So it's an insurer program. So usually you're paying the insurance premium. In some cases, even if you're putting 35% down and buying your own home, there may be ways that you can have it insurable, it's called, which means that you don't pay the insurance premium, the bank does. So you still get a really competitive rate and can state your income to qualify. The only key or downside with insured mortgages is that its purchase is under $1 million and the maximum amortization is 25 years. The last one I want to talk about here too, as far as creative solutions for self-employed, is B lending. So we've been talking a lot about bank lending so far. B lenders are a little bit different. They use the bank statements to determine the income. And so they're going to look at your 12 months of bank statements and determine what income is reasonable for your business. And in general, it's minimum 20% down, but sometimes they do need 25% down. And if you're buying a residence or a rental, they're usually okay with that, although usually a rental requires minimum 25% down with most of the B lenders, not all of them. So quick question, if you only own 50% of the company, very few lenders will allow you to use corporate net income in that case. If you and your wife, for instance, own the company together, then as long as both of you are on the mortgage application, then you would qualify. But if it's you and a separate business partner, then that makes it more difficult. I won't go into a lot of detail, but there is a solution for that. And it's if the operating company's here, you can set up holding companies that each of you own 100% of, and then you flow the dividend and income into your own respective companies. So there is a solution for that. I won't go into a lot of detail in this webinar, but if you do have a situation like that where you don't qualify because of this, there is a way that you can fix it moving forward. So on the income side, Nan, you'd be filling in the income and looking at that, and now you're also able to assess, am I even in the ballpark and being able to qualify? As a first-time home buyer, a lot of your work is already done here on the game plan because it really is trying to assess, what is my what is my down payment, and then what is my income, and then you can start to look at, okay, do I think I'm going to be able to qualify for this mortgage? I want to buy something for $500,000. I have $100,000 down. I need a $400,000 mortgage. Okay, that means you're going to need an income of about $100,000 a year to qualify for that. So if you don't have a lot of debts, then this is fairly straightforward. Now, for those of you that have a portfolio, this is a bit more complicated. Now, we have on the portfolio game plan a spot where you can put in the city, the province, the value, the mortgage amount, the monthly payments, and the monthly rent. Now, there are a lot of different ways that you can get pretty deep into this and try to figure out how much you qualify for all on your own by going into this. Now, one of the things that I'm going to preface this and suggest is that this is very complicated, but I will go into a quick highlight of how much you would probably qualify for on rental income. So here's what most lenders do. Most lenders take 50% of the income, add it to your income, and then they only want about 40% of your income to be used towards all of your debts. And so if you had $1,000 a month in rental income, underneath this method, they would take $500, so 50%, add that to your income, and then they only want about 40 or 44% of your income to be used towards all of your debts. And so that gets watered down further, down to about $200 or $220 of income being used. So this method does not give you a lot of borrowing power. Some lenders use an offset, and this number usually is between 50 to 80% in general. And so if 80% of the rental income covers all the expenses, then there's no net effect on the debt servicing. And so what they would do here is an 80% offset. They would take 80% of $1,000, so $800, use that $800 to offset all the expenses first, and then whatever's left over, if there's surplus, then they add that to your income, and if it's a deficit, then they add that in as a liability. So without getting into the math too much, an offset is significantly better because in that case, they're actually using $800 of the $1,000 towards all of your debts, as opposed to only using 50% of the income and then watering it down even further. And then last is what's called a DCR, debt coverage ratio. And I won't get into detail on this because this is more of a commercial lending avenue. And it's a program that usually lenders use only when you have 2 or 3 rental properties or more. But basically, they want to see that the property portfolio all produce positive cash flow, usually about 1.1 or 1.2 times income to debt. and also the property that you're financing. And so they all use all of the income, but they need to see that overall the portfolio is showing a surplus in order to be able to qualify. There's a quick question here from Kevin, just about making sure. So the question is, if I have a percentage of a company with partners, I can't use the income from that company to invest. However, you can set up your own company to hold the shares and then use that as income as it flows through your own company. So yeah, so Kevin, if you and your partners all own shares in that company, not personally, but in your own companies, then what can happen is if you dividend from the operating company that all of you own into your respective holding companies, then if you have a surplus of income, a corporate net income that goes into your holding company that stays there, and you have a 2-year history of surplus of income going into that company that stays there, then you could use a corporate net income program. So feel free if you want to just dive into that a bit deeper, then I'm happy to take that offline, and you can send me an email with some more details. And we just talked about this because at the end of the day, it's quite complicated here. If you punch in all your portfolio, well, you don't really know, how much rental income does this lender use or that lender use. Having all the expenses calculated in here, it's very complicated. There's a lot of moving parts. I know that some of you already know this, but I've been working on some software called Atlas, and the purpose of Atlas is basically that it allows us to underwrite for many different lenders all at the same time. So if you want to get a high level view of whether you qualify or not without going through this exercise manually, then we do have a way that you can provide us with information on a spreadsheet. We don't need any documents to back it up. We're not going to pull your credit. And we shop 32 lenders with all of your inputs, and then we can deliver a report back to you automatically within 5 minutes. And for something that we take a look at and provide some input and advice to you on, then usually it's about 1 or 2 day turnaround to get back to you on that. So this is how we're usually able to turn around complicated files fairly quickly, is because we've built this software. Our initial version was built in Excel, but we can take a complex portfolio with a number of properties, and we can map out whether the deal qualifies or not with a large number of lenders and for all of their programs. So it's complicated. We're turning that into software now and actually building that engine and kind of redoing a little bit of how we do it. But we're excited to be able to deliver that soon in a different way and ways that we can interact with our customers, where eventually we'd love to be at a point where our customers can input the information in themselves and pre-qualify themselves in the future. How cool would that be? So now that we've talked a little bit about your current portfolio, if you wanted to run your own numbers, you can do it in a couple of different ways. So in your existing portfolio, you could just take 50% of the income and then subtract the rental payments and see if there's a shortfall or a surplus. The reality is most lenders don't use enough rental income to qualify, and so your existing portfolio likely is hurting you, not helping you. But it's much easier for us to give you that information if you decide to work with us, or if you want to use the Atlas software. Very easy for us to tell you which each property. We can even see with different lenders which properties are affecting you the most and the least, which is nice. So once we've looked at the existing portfolio, now we need to look at, well, where do we want to buy? So if you're an investor, you're probably looking at like, which province do I want to be buying in? Where do I want to buy? And you're going to start to think about, what types of properties makes the most sense. Now, one of the things that I usually recommend is you try to be a funnel. You don't want to be looking in every single market everywhere. You want to try to figure out which markets seem to make the most sense, and then try to whittle it down. You will find in different markets, different types of properties can make more sense. For instance, for many years, it's very difficult to get properties in Vancouver to cash flow. And this is getting a little bit harder, of course, with the new short-term rental rules that are coming out. But we found that in many cases, medium-term, fully furnished leases often was a way of generating more rental income in the Vancouver market. Then if you looked at Edmonton or Calgary, in Edmonton specifically, we found that the duplexes and the fourplexes often generated really good cash flow, and those are the properties that tended to perform better in those markets. And so you'll find that different markets will have different types of properties that seem to perform better or worse than others. And so you want to start to look at, well, what in a perfect world would I like to purchase? And you can start to map out, okay, overall, over my 5-year plan or 10-year plan, I want to have a couple of properties here, a couple of properties there. You can start to map out the approximate cost in those markets, how many you'd like, and then you look at the total cost. And then the reality check comes, and now we have to put it all together. So the key is, if you're refinancing and coming up with existing debt, you have to look at what is your existing debt, and if you're refinancing to come up with more down payment, can your income support the existing debt that you're going to be having, plus a new debt on purchasing a new property? In general, the first step is, will your income even support your existing debt? So if you have a $300,000 mortgage and you're hoping you can refinance 500 grand more and pull that out, your income needs to service an $800,000 mortgage. And that's going to require a fair bit of income in order to be able to do that. That needs $200,000 of household income just to service the $800,000 mortgage. And then in general, you need a bit of extra income just to be able to carry any rental properties that you plan on purchasing. So make sure that you keep that in mind. Again, this is where it gets complicated. Every lender uses different percentages of rental income, and that's where it gets more complicated to know how much exactly you qualify for, but that's where we can help. Another thing that's important is, do you have enough cash to purchase what you want? So if you, on this sheet here, if you said, yeah, I'm going to buy $10 million worth of real estate, okay, awesome. Do you have $2 million of available cash? And $2 million, by the way, is going to be the bare minimum here, because you need at least 20%. In many cases, you may need more than 20%. So this is something you need to take a look at. And the next step is, if the answer is no, that's fine, but it doesn't even mean that maybe you need to start looking at involving joint venture partners. And I myself have done and been involved with a lot of our clients in many joint ventures, so I'm very familiar with those. But maybe if you realize, I'm really good at finding good deals, but I just don't have enough cash, then maybe you try to find joint venture partners that are interested in doing a deal with you. And the other thing that you want to look at too is, how long do you want to take to build your portfolio? If you're thinking that you want to be really aggressive with it and go 5 properties a year, well, that's a very different game plan than somebody that just wants to buy 1 property every 5 years. Very simple and very easy to put that kind of plan together, but something that's a bit more aggressive, it's going to require more capital, more planning, and more support to be able to build that. So that's the general idea of kind of creating a bit of a game plan for yourself, and then also trying to make sure that it actually makes sense, and giving everybody a high level view of how the lenders look at things, how they treat things. But that's just part of the equation, trying to map out, what you can qualify for, and how, and what types of things you need to be looking at, making sure you eliminate your non-mortgage debt, making sure you have a HELOC. All those things are important. Obviously, I'm sure what you're all waiting for and all want to hear and talk about is what's happening with interest rates. And I will say that the last 2 weeks, during the holidays and the first week of January, usually those 2 weeks are relatively slow in the mortgage world. This last stretch here was very, very busy. A lot of people all of a sudden wanting to get prepared, wanting to look at buying something. And so I think that our investor clients are seeing what a lot of people are seeing, which is the fact that, hey, you know what? I think that the market's going to go up, and I think that rates are going to come down, which is going to push the values up. We did see last spring, when the Silicon Valley Bank situation happened, interest rates for the fixed rates anyways started to come down, and the market actually spurred and got very, very hot. If interest rates drop and they continue to drop, then you're likely to see that more people enter the real estate market again. And if you have more people wanting to buy and not as many people wanting to sell, and of course we have a huge amount of inflation and pressure on the real estate, which has been mostly curbed by the fact that the interest rates have gone up, but we also have a huge amount of immigration coming into the country. So we haven't really seen values drop a whole lot, even though the interest rates have gone up considerably. Values for the most part have held fairly well. The concern then is, if interest rates are dropping and a lot of people are moving here, well, what's going to happen with values? So of course we need to understand, well, what's happening with interest rates first before we really can predict what's happening with values. Bank of Canada right now, they've currently paused, but they're not really wanting to signal this right now, but the general consensus is that they're likely to be down this year. And so 2024 looks like it's probably going to be the year that the Bank of Canada starts to decrease interest rates. The general idea here, if you talk to a lot of economists, is that the fixed rates probably by the end of the year will be down about 0.5 to maybe as much as 1%. And the prime rate is looking like it might be decreasing 1 to maybe even 1.25. A lot of economists have now been saying 1 to 1.25. More of them leaning towards 1.25. I'm still a little bit hesitant to suggest that. That's fairly aggressive in my opinion. But I have been suggesting that maybe a 1% decrease this year might actually come to fruition. Now, I don't usually like to make predictions myself. I usually like to get my information from other people. And so this chart here is the implied Bank of Canada overnight lending rate. So what I mean by that is if you just look at the left column, it's showing all the meeting dates for the Bank of Canada. And on the right-hand side, that basis points, it's all red, meaning that their expectation is that the rates are going to go down. Now, Bank of Canada usually moves in 25-point decreases or increases. And so that's a 0.25% decrease. And so if you're looking at this chart and trying to understand, well, what am I looking at here? It's basically implying that at the April meeting, there's a very good chance the Bank of Canada will have gone down 0.25% by that. And that by the June meeting, a higher than 50% chance that they would have decreased again. Not quite 100% chance, but higher than 50% for sure. And then by July, almost for sure locked in that there would have been a total of a 0.5 point decrease from the beginning of the year. By September, more than 100%, or they're thinking there's a very good chance that they would have been down by 0.75%. And then by October, almost sure that they would have been down a full 1%. And by December, there's about almost a 50% chance there that it would be down 1.25. So that's the way to kind of understand that and look at that. And this is what people are trying to basically, it's people that bet on what the Bank of Canada is going to do. And you can see how specific this is. It's just little nudges of what are called basis points on this. But at the end of the day, I've been watching this quite a bit, and really this chart hasn't changed a lot over the last month and a half. The expectations of the Bank of Canada is probably going to drop about 1% over the course of this year. And it's interesting to me to see that the chart is expecting that the first decrease would be as early as April, because it wasn't too long ago, late in the fall last year, that it seemed like Bank of Canada probably wouldn't start to drop until like the summer, and now it's seeming like it's likely in the spring. Now, what does that mean for you? If you have a mortgage coming up for renewal, you're taking a new mortgage, you're buying a new property, etc. If you can get a deep discount on a variable, the math is in your favor. So I ran some numbers on this, and we have a spreadsheet we're happy to share. If anybody has a mortgage renewal coming up, or if you're working with us on a purchase or refinance, we do go over this with our customers to compare a 3-year fixed rate versus a variable rate. And just so everybody's clear, the rates that I've used here are kind of the average for a 3-year fixed rate. The variable rate depends. It's better than average for what's called a conventional mortgage, but we do have some lenders offering that. And then for insured mortgages, in both cases, you can get lower interest rates. And so I'm just picking some rates, and usually we actually specifically look at your scenario and then map it out. But on a $600,000 mortgage, in theory, over a 3-year period, your interest savings would be about $9,000, which is not insignificant. And this chart actually, in our Excel, we haven't updated it for about a month or month and a half, and the trend has been that the Bank of Canada is likely to move down earlier, which actually would be more favorable for the variable. We haven't changed the chart as of now. So it does seem like a variable pencils out better. I just know that many, including myself, are hesitant to recommend variable when the rates increased a lot more than anybody expected, and we're still not out of the woods yet. But this is what people are expecting, and based on those expectations, this is what would happen. But I have to preface it by saying that a year or two ago, the expectations were also that the Bank of Canada was not going to go up this high. And so you need to be very careful with taking and choosing a variable rate, knowing that you're going to start off at a rate that's about 1% higher than if you just took a 3-year fixed rate right now and lock in the savings immediately. But the thought is that if the Bank of Canada goes down to 1% over the next 12 months, well, now you're already at the same rate as the 3-year fixed. And then if it continues to drop into year 2 and potentially year 3, then you're just locking in that savings in years 2 and 3. So a couple of things that I just want to quickly highlight and go over here is when you're looking at your game plan and structuring things, it's really important to look at preparing your taxes properly. especially if you're self-employed, if you're planning on buying properties this year, we can work with you and your accountant to reverse engineer what your taxes need to look like in order to be able to qualify to achieve your objectives. So just keep that in mind. And a lot of the time, it's just a matter of looking at it and just giving you the information. It's like, well, if your accountant files it here, which is what they want, then you're going to qualify for this much. But maybe if you restructure this or you increase your income a little bit over here, maybe we can get you to where you need to be. Because ideally, what you're trying to do is pay the least amount of tax and still qualify for the best mortgage. That's the ideal circumstance. And some cases, you'd have to pay yourself way more to qualify for a better interest rate, and the taxes are going to cost you $50,000, and the mortgage is going to cost you an extra $12,000. Well, you're better off just paying more in the mortgage and less in taxes, right? On the flip side, sometimes you just nudge up your income, and that's the difference between you being able to go with a B lender only and going into an A lender. And if you just nudge it up, maybe you pay an extra $2,000 of taxes, but now you get to save $10,000 in the mortgage. Well, that does make sense. So it's really important. If you have an idea of what you want to do this year, then structuring your taxes properly is really important. Now, another important thing is if you have a pre-sale, not even if it's just completing this year, but if it's completing in a couple of years, remember that lenders use a 2-year average for the income. So if you have something completing in 2025 or 2026, they're going to be using the previous 2 years of income to qualify you. So if you have a pre-sale in 2025, that means they're going to be taking the average of your 2023 and your 2024 income. So if you're self-employed, well, right now, you can literally be planning for what your 2023 income would look like, and then starting to structure out what your 2024 income would look like too. And that would help you qualify. Been talking so much, I'm losing my voice. Anyways, another item is to eliminate the non-mortgage debts. We talked about this earlier, but if you have a car loan with a $600 a month payment, that decreases your ability to qualify on the mortgage by $100,000. It's really important that you look at this and try to make sure that you eliminate any of the non-mortgage debts. Otherwise, you won't be able to qualify for as much as you'd like. In many cases, if you have a mortgage coming up for renewal, if you do have other debts, it does make sense usually with your renewal on your mortgage to look at just refinancing, increasing it to roll up all that debt into the mortgage. It usually reduces the income reduces the interest cost, and usually can also reduce the payments on that debt as well. Another thing that's really important, you got to shop your mortgage renewal. I'm finding that depending on which lender you're with, some lenders are very aggressive on pricing right now, and some are not aggressive at all. We've seen one major bank in particular that they had a new CEO come in, and the new CEO said, you know what, we have too many mortgages on the books. We need to unwind that. And so they've been actually fairly uncompetitive on rates. And so that's something that you'd want to keep in mind. So if you have a mortgage renewal coming up, it's important to shop it. You can very quickly email myself or my team. Just let us know here's what rate is offered. And we can give you an idea and say, you know what, we think we can beat it, or you know what, your bank is really competitive, but at least you get a second opinion on that. And I think it's really important, especially with how high the rates are right now. You should be getting a second opinion to make sure there's no other better option available for you. And the last thing I want to talk about is all of this is great. All of the planning and thinking about what to do and how to do it, and all of that is awesome. But none of it matters if you don't actually take any action. So it really comes down to creating a game plan, and then taking the action necessary after that. Nothing matters if you don't take the action. So really important as a kind of a final point to do that. Now, if you do want to learn more, we do have more information on our website. We have a webinar coming up on February 7th, same time, 7 p.m. We're looking at likely talking about how to deal with a mortgage renewal at that webinar, by the way. So if you do have a renewal coming up this year, then you may want to attend that. We have our first-time home buyer guide, our investor guides, and our private lending packages available on our website, and of course an FAQ. We also, if you'd like, we're happy to book a consult with you and go through your game plan. This document that we sent over to you, you can fill that out and send it over to us, and we can set up a call to go over things and give you an idea of, okay, so based on this information, this is what I would probably propose. You could do this, you could do that. It's very easy to do that as something over the phone to even see if it makes sense to start a mortgage application. I really don't like to waste everybody's time. If you're not able to likely qualify for a mortgage, we're not going to get you to send in a bunch of documents and then waste your time collecting them, and for us to waste our time processing them and reviewing them. So often, just with this game plan filled out, we can often look at it and give you an idea. Also, I mentioned earlier with our Atlas software, if you do want to go a little bit deeper and know exactly what you may qualify for, we can send that over to you. So you can also send an email over to info@greenmortgageteam.ca and engage with us in that way as well. A couple of books that I do have at the office. I'm running low on this one, I think, but this is the Mastering Mortgage for Financial Freedom. This is talking about something called the Smith Maneuver. That's basically how to make your mortgage tax deductible. So something to keep in mind and to look into. And if you do want to learn more about that, then I'm happy to share that. Send us an email and let us know your mailing address and that you'd like a copy of this book. And then for those of you that are wanting to learn more about investing in real estate, I did write a book a couple of years ago and became a best-selling Amazon author, Rockstar Real Estate Investing. And so it's really good about giving the fundamentals for investing in real estate. And even if you're just buying your own personal residence, you can always learn a little bit about investing in real estate by reading that book. So I'll wrap up and now I'll take any questions. If anybody wants to go through anything, feel free to use the Q&A to listen to any questions. And then I think there were some questions that came up in the chat, so I'll try to dive into those as well. Let's see here. So I've got a question here. I have a variable mortgage on a rental property worth $1 million, and the mortgage is $400,000. What is your suggestion, to keep it like that and wait for the rate cuts, or to transfer to fix the mortgage? Right now, I do not have a problem paying my monthly payment. So very good question. If you don't have an issue paying the payment, that does at least eliminate one part of the equation. The question then is not just what is the payment difference going to be, but it's just what's the overall interest cost going to look like. So in this case, I would probably run the numbers through that spreadsheet that I have. But it really depends on what the variable discount you have right now is. If it's prime -1, my spreadsheet is going to tell you to just ride out the variable, and that will result in you paying less in interest. If you're at prime, might be a closer call, and maybe you ride it out for a little bit and look at locking in. But I think the reason that I like the variable is that you can lock it into a fixed at any time. So if we expect rates to go down, then you can always just ride it out and wait, and then eventually lock it in when if and when the rates go down. So that's something that I would consider. But we can always do the math too if you wanted to just run the analysis. Then I'm happy to do that. I have another question here. If my home's appraised value increased yearly, how does the HELOC ceiling reflect that? Do we need to get the bank to update the value of their home in their records at the time of renewal? It's been very difficult actually to get data from the banks on how they're going to process that. My understanding is they're probably getting macro data, probably through the assessments through the municipalities and whatnot through each province, to just determine whether you're at or underneath that limit. But if you're noticing that the bank doesn't seem to be accommodating that, then I would probably suggest you should be reaching out to them to say, by the way, my home value is now X. Can you make sure you update the system so that my HELOC is actually increasing for every payment that I pay down on it? Because they haven't really determined or at least released any information as far as how they're going to determine that yet, and we haven't seen that yet. I've got another question from Ben. Thanks for the great information. I've got 2 properties with mortgages at 2 different lenders, and both are up for renewal this year. Is there any benefit or advantage to getting both with one lender? It depends. You'd be surprised. You would think that if you brought 2 deals to a lender, they'd be more inclined to take it. But today, the risk management people kind of run the show, not the salespeople. And so in some cases, it can be more difficult to qualify. What you find is that some banks do look at it and they will price the second deal. Like once the first one is there, they might be more likely to look at pricing being better on the second one. And some lenders do look at the overall amount of money that you're borrowing. And if you're taking 2 deals to them at the same time, then you can probably get them to look at each. It doesn't usually have much of an impact, though. Most banks aren't going to give you a drastically better interest rate if you take 2 deals to them instead of just one. Hey, Denver. Yeah, thanks for attending. Good to see you. Let's see here. I've got another question here, which is if a person started working as an employee in 2023, how many months after starting would they need to wait to try mortgage approval? So the reality is, if they're off probation, then you can get a mortgage right away. Usually that means that they have to be working there for 3 months. Now, even if they're still on probation, if they started that job and they have previous experience doing a similar job in a similar industry, then you may not even need to wait until they're off probation. So in some cases, you can get a new job and get one pay stub, and the bank can give you a mortgage. So it does depend on a little bit more of the backstory of the situation with regards to the new employment. In particular, too, if there's a massive jump up in salary, they might not be as inclined to give you a mortgage right away until you've been there for at least the probationary period. So it just depends on the situation. Just a quick question here is I missed your reply to the question above regarding owning a rental property and wanting to buy a personal residence. Can I still use the FHSA and or RSP? I'd have to double check that. So I don't know the exact answer to that. I know the property transfer tax is something where if you have not claimed the exemption on an owner occupied home and you bought a rental, then you could still use it and you'd still be qualified. But I believe the RSP plan requires you to not be on title. So you can check the resources, and I'll probably check the resources myself after this, but feel free, anybody who does want an answer, and if you can't quite figure it out, just send me an email and I'll be able to clarify that shortly. Awesome. Let's see here. There's another question here. I have a duplex and a triplex rental properties. Someone said we should do commercial mortgages. Is that true? It depends. So commercial mortgages qualify very differently. And so it really depends on your personal qualifications. Residential, if you have high income, it's easier to get financing that way. If you don't have enough income, then sometimes you do need to use a commercial lender. And commercial lending is based off of mostly the income of the asset itself and less based on your personal borrowing power. There's also small business lending, which is kind of in between residential and commercial. And sometimes small business lending can still treat it the same way for the approval process and underwriting, but the rates aren't quite as high as commercial. So it really depends on exactly your circumstances. That's something I'd be more than happy to look into and see what options you have in residential. Usually we start with residential for residential properties because if you can get financing there, you can, in theory, get more money and for cheaper. But if you can't get it there, then we often look at commercial as a backup. Another question, is there a concern to having severable, sizable, unsecured lines of credit that have zero balances for a number of years? Do these limit our borrowing power? Almost never. So lenders usually just look at the balance, not the limit on unsecured credit limits. And so you shouldn't have to close down or reduce your credit limit. You should be okay to keep it there. It's really more the balance, not the limit. Another question, borrowing from your RSP for the down payment, how much do you need to pay back each year? Asking for a friend as they've never done that before. So they usually just stretch it out over the 15 years. So if it was $30,000, then they typically want you to pay back $2,000 per year into the RSPs. Another question, if you invest in a revenue property for the first time with an investment partner, you must use your first-time home buyer status. So on the property transfer tax, no. So if you bought an investment property first, then you pay property transfer tax on that investment property, but you would still be eligible in the future. However, taking out money of the RSPs or the FHSA, we need to clear that up because I'm unclear about that. The way that I read the guidelines is that if you have owned real estate in the last 4 years, then you would not qualify. But there may be a exemption there if you didn't live in the property. So that might be something to look at. There's another question. Does investment income, dividends, et cetera, count as part of the income to qualify for the increase to the mortgage? So yes, if you're not taking out those assets that are generating those dividends out for your down payment, and you have a 2-year history of that on your tax returns, then we can use the dividend income to help you qualify for a mortgage as well. Also, we didn't get into it today, but if you have a large amount of money in liquid investments, there are some net worth programs, and some lenders will allow you to use your net worth to increase your borrowing power. So as long as you have at least $250,000 in liquid net worth, then you may be able to qualify underneath a net worth program where they basically allow you to borrow. If, let's say your income only qualified you for $300,000, but you had $500,000 of assets, they could add the $500,000 in additional assets your borrowing power, and now you can qualify for up to 800,000. There's a lot of nuances there, but just keep in mind that if you do have a large liquid net worth, you may be able to qualify for more money that way. And then another question here: what regions of BC can an Albertan be able to invest in without being within the foreign buyer tax? Which regions? You know what? I have to double check. There's a large there's a laundry list of different regions that are inside and outside that. So it's a long list, but you can actually find that online. It's not that difficult. Awesome. Let's see here. Oh, I've got something in the Q&A too. Thank you, Kyle. Very informative question. What's the difference between the variable rate 3 years and 5 years, and which one is better? Typically, the 3 year and the 5 year are almost always the same. Typically, you'll find that most lenders only have a 5 year variable, by the way. There's very small lenders that have a 3 year variable. Most of the lenders, their 3 year variable is actually more expensive than the 5 year variable. So just something to keep in mind. But the difference between them is usually about the same with the lenders that have it. But in some cases, with some lenders that do have it, it's actually more expensive to take the 3 year variable than the 5 year variable. And then the next one is, do you do mortgages in all provinces? So not in all provinces, no. But we do have contacts and people that we can work with in some of the provinces that we don't work in. Usually, if you're buying in a province that is outside of BC and Alberta, then we do have contacts in many of the other provinces. In Ontario, in particular, we can do business in Ontario basically through our head office. And we basically set up everything, prepare it, and direct it, and then we're just submitting it through another process or another route. So we're able to do that. But there are some provinces that are a bit different, like Quebec, for instance. We typically will work with a broker that we know and trust in Quebec. Awesome. Any other questions? Well, I'm sure if any other questions come up, let me know. You can email us at info@greenmortgageteam.ca. I hope this was helpful and enjoyable. Oh, I have one more that came in here. Any personal opinion on BC assessments this year? I just found out my Vancouver residence went up $95,000 from last year's spike. Seems unreal to me. Good question, actually. So I actually know of a service that will help you refute your property tax BC assessment, which determines your property taxes. So if this is something that you think is unreasonable, then they will do an investigation into it. Basically, it's an appraisal company that will look into it and determine whether they think that valuation is on or off. And so they're happy to look into that for you and give you some feedback and some details. So if you want that name of the company, then reach out. Now, in many cases, values actually did go up. It just really depends on where and what exactly you own. And so you want to check that out. Also, keep in mind, it was as of July 1st. Now, the Silicon Valley Bank thing happened. Fixed rates went down for a little bit of time, and then the market started to heat up and into March, and especially April and May, and then starting to cool off by June. The market was actually fairly hot, and so I think that pricing as of July 1st might be the pricing that they're looking at and using. So you might be able to refute that because the second half of the year is definitely slower than the first half. Awesome. Thanks so much for attending the webinar today. Hopefully it was helpful and useful. Reach out if you guys have any questions. And yeah, it was good to see everyone. So thanks so much. Looking forward to seeing you again.